Welcome to our webinar, Navigating the Ukrainian Crisis. I'm Erik Ristuben, Chief Investment Strategist of Russell Investments. I am joined today by Kate El-Hillow, who is our Global Chief Investment Officer, and Rob Balkema, who is the Head of Multi-Asset Solutions for North America. Our plan today is to share with you a view of kind of the macro geopolitical and economic issues, and then talk a little bit about our response to this crisis in kind of a broad, circumspect way, with Kate walking us through all the things that we're doing in terms of making sure that we're navigating this on your behalf as effectively as possible. And then we'll bring in Rob to talk about some of the details, how our market's functioning, and kind of what our manager's saying around the crisis as a whole. Now, it's important to understand that this is, at this point, more of a geopolitical event than a macroeconomic event. The two can conflate, but at this point, we believe the principal issues are contained from an economic perspective as it relates to Russia and the Ukraine. Geopolitical events are always complicated and can be very scary, particularly watching the massive humanitarian toll that we're seeing in the Ukraine as the Ukraine is valiantly resisting the Russian invasion. But if you take a step back and kind of begin to understand the dynamics of kind of how did we get here, the first thing we would say is that we and the vast majority of managers and market participants that we talked to prior to the invasion thought a full-scale invasion was a low probability event because it wasn't viewed as in anybody's best interest, including Russia's best interest, to do this. But Putin clearly had a different calculus involved. When you look at the core issue from a geopolitical perspective, if you look at a map of the world and specifically look at a map of Eastern Europe, what you will find is that Russia shares a border with a number of European nations, of which only the Balkan states, Estonia, Lithuania, and Latvia, are members of NATO. If you recall, kind of going back into history books, you know I'm a son of a history professor. NATO was established to be a counterbalance to Soviet encroachment in Europe. It has become, post the fall of the Soviet Union, not entirely, but to a large degree, an offset to potentially Russian influence in Eastern Europe as well. When you look at that border, only those three countries, and it's a relatively small border with actual NATO countries. The other countries that have large borders with Russia are Belarus and the Ukraine. On the southern end of Russia, went by the Soviet Union, the southern end of Russia, Georgia, is a province that has a fairly lengthy border with Russia as well. In order to provide a buffer between him and NATO, Putin has been pretty deliberate over time to make sure that he continues to have a buffer and that he isn't completely surrounded by NATO countries. So he set up a puppet government in Belarus. We're seeing that play out in this crisis as many of the troops that have invaded Ukraine are coming from Belarus. And he's also done the same thing in Georgia successfully. I think his calculus was he'd be able to do the same thing in the Ukraine, stop them from getting closer to NATO influence and potentially actually join NATO. I think his view was he could do what he did in Georgia, is to invade, create a puppet government, and then extricate himself from the situation. I think it seems that his calculus was probably he didn't expect the level of resistance that he's seeing. I think probably suspect that he also didn't expect the Western countries to be as emphatic in his response to the invasion in terms of the sanctions that we've seen. We'll talk about those in just one moment. The reality is that that's kind of why we thought it wasn't in anybody's best interest. Certainly not in the best interest of Ukraine for a full-scale invasion, not in the best interest of Western Europe for a full-scale invasion, and not in the best interest of Russia. But here's where we're at. We're in a full-scale invasion at this point, and the response has been rather emphatic in the West. Massive sanctions have been placed on Russia. Historically significant sanctions have been placed on the Russia. The end goal of those sanctions is effectively to destroy the Russian economy. I mean, we could kind of we could gussy that up with niceties. But what we wanted to do is we wanted to basically seize the Russian economy. We've basically created conditions where it's going to be very difficult for industries other than energy to export or import into Russia. We have actually placed sanctions on the central bank of Russia to greatly inhibit their ability to cushion the blow of these sanctions to their broader economy. They had built up a $650 billion war chest in order to be able to do that. A lot of those funds are no longer available to them in order to actually do that. The other things that we were aiming to do was to put the ruble in free fall and create a highly inflationary environment in Russia. The ruble has lost 30% of its value since the beginning of the invasion. And the central bank of Russia has increased their key interest rate, doubled it from 10% to 20% in an effort to kind of fight the effects of what will be, in their estimation, massive amounts of inflation. Additionally, locking up the banking system has created runs on banks across the country, long lines for ATMs, long lines to get into banks. Russian citizens, capital controls have been placed. Russian citizens can no longer take capital out of Russia. And equity and fixed income markets, local markets have seized. The Moscow Stock Exchange has been closed and is not expected to open until the earliest next week. And many of the managers that we talked to think that's probably a bridge too far. Bond markets are also not functioning. So there is clearly, we're already seeing the effects on economics of those sanctions on Russia. It's important contextually to understand that Russia and Ukraine together are a small portion, very, very small fraction of global economic activity. And they also represent a very, very small fraction of overall market capitalization in equities and certainly in the bond market. So the event has yet to metastasize in our minds to a macroeconomic event, but there are three escalation paths that we're watching very closely as it relates to these issues. One is kind of the military escalation path. That is that for some reason, Russia doesn't stop with control of Ukraine and somehow ends up in a direct military engagement with a NATO country. Article 5 of the NATO treaty, and this is what defines who's an ally, is that an attack on one NATO nation is an attack on all NATO nations. So if for some reason there was a military altercation with a country like Poland, say, who we all know is really close to the situation, then it would be the expectation that the full forces of NATO would be engaged. That is an extraordinarily low probability event. Putin himself has said that is not his intent for clear reasons. And so we expect that to not be a significant risk, but obviously it would be a huge impact if it were to actually manifest itself. I would not let that issue keep you up at night. Another path of escalation is cyber war or cyber attacks. It's important for all of you to understand that massive amounts of cyber attacks have already occurred. A massive increase in the amount of attacks that we are seeing on Western nations, ourselves included. Our internal systems groups is monitoring that, and we are seeing a very highly escalated level of cyber attacks on us and individuals. So that is something that is broadly understood within the marketplace. We would very much encourage you, both in your personal life and your professional life, to be ever vigilant about those attacks. Because they're coming. But the concern is that those attacks already escalate even further, and that maybe specific infrastructure like power grids are actually attacked in the West. Again, not happening yet, but something to keep an eye on, because that would probably lead to another risk-off event in the marketplace. As to whether or not that risk-off event would actually stay is a separate issue. The last area of escalation is the one that probably we're monitoring the most closely. Famously, John McCain, when Russia invaded Crimea in 2014, had a quote, which is one of my favorite quotes of all time, that Russia is a gas station masquerading as a country. Russia is an energy-dependent market. All of these sanctions that have been applied to Russia exempt the energy sector, which is interesting. But the reason is that Europe gets 40%, 40+% of its natural gas from Russia, and Germany gets 60% of its natural gas from Russia. If we were to apply those sanctions to Russian energy companies, that would have a very serious negative economic impact to Europe. And then Europe is significant. It is a large portion of economic GDP and market capitalization. That would then be a macroeconomic threat to the economies of the world. Again, not expected to be likely because it's in no one's best interest that it occurs, but something to monitor. But the other issue is much more obvious and much more pronounced at this point, which is energy prices are rising. Uncertainty around energy supply is actually creating uncertainty around prices in energy marketplace. And we're seeing WTI actually trade above $100 a barrel. First time we've seen that in a long period of time. We're monitoring that. At this level, we don't think that's a macroeconomic event or macroeconomic threat. But if we start seeing those numbers go to 130, 150, then that could actually itself potentially raise a risk for the growth trajectory of the US and the globe. But the other thing that's a knock-on effect that's getting a lot of press at this time is, will that higher inflationary pressure of energy create more persistent inflation and therefore change potentially and affect Federal Reserve policy as well as other central bank policy? Our view is not significantly at this point. We actually are holding to our forecast that we had prior to the invasion, that the Fed would begin to raise rates in March, that they would raise 25 basis points in the initial meeting, and that they would continue to raise rates at a pace that was closer to 4 or 5 rate increases than what the market was pricing in a week ago of 7 rate increases. Subsequent to the invasion, what the market's done in terms of its pricing is it's lowered its expectation. The Fed will raise rates to 50 basis points in 2 weeks' time to 25 basis points, and has cut the number of rate hikes in total that they're expecting from 7 to 5. We haven't changed our forecast, and frankly, that market consensus is coming back closer to what our expectations were. So we're still expecting core PCE inflation rates to be closer to 2 than to 3 at the end of the year, and we are expecting the 10-year Treasury rate to be at about 2% at the end of the year as well. The market seems to agree with us at this point. When you look at kind of S&P 500 and TSX performance year to date, welcome our friends in Canada, they're basically flat from where they were relative to the start of before the invasion. The 10-year government bonds for both countries are down kind of in the area of 10 to 15 basis points, which is a little bit of a risk-off event, but not a significant one. Credit spreads have widened, but not substantively. So all in all, I think our view that the macroeconomic impact of this conflict are contained at this point to Russia and the Ukraine is something that the broad market tends to agree with. That said, there are lots of issues that we are dealing with on your behalf, and I'd like to introduce our chief investment officer globally, Kate El-Hillow, to the conversation. And Kate, maybe you can cover what we've been doing at Russell Investments to respond to this overall crisis.
Great. Thanks so much, Erik, and thanks everybody for joining us today. Just to reemphasize some of the points that Erik made in putting this in perspective, Russia is clearly punching above its weight in terms of what it's doing to the markets, despite the fact that from a global capital markets perspective, it's a pretty modest allocation within the benchmarks. And that's also true of exposure within the portfolios. But as we headed into the event, just to paint that picture, portfolios were positioned more neutral at the total portfolio level. So not risk on, not risk off relative to our long-term positioning. One level down, we were overweight, more cyclically oriented assets that tend to do well in a recovery period. But we had taken that down materially throughout last year, just as we hit later stages of the recovery and wanted to realize gains. And similarly, from a Russian exposure perspective, our managers had been taking down risk throughout the year, both to take profit, but also to reduce risk, just given geopolitical concerns. And so as we entered this, we were kind of at this neutral point from an overall risk perspective. And at this stage, we've determined that we're going to be maintaining risk levels within the portfolio at the level that we had when we came into the event. So that means we are rebalancing portfolios. We want to keep your strategic risk posture in place, but we're not adding or reducing risk relative to where we entered the crisis. And with the benefit of modest Russian and Ukrainian exposure across our portfolios, at this stage, and even before the sanctions started to hit, we have limited trading on securities in Russia, Ukrainian, and Belarus names, just mainly because we didn't see the benefit of leaning in to take on more risk in those areas or to lock in losses. And it's easier to make that decision too, just because the relative allocation within the portfolios is pretty modest. But that was our current stance. As Erik kind of alluded to, there are a set of risks that we are actively looking at. And in these types of geopolitical situations, it's hard to predict kind of where things could start to go, both in terms of the outcome, but also the duration of the incursion and the invasion. And that can have material impacts to both our cyclical view, where we came into the year thinking moderate growth, but still a positive picture. And so as we look at the key things that are going to drive us making changes in the portfolio, we're leaning into our process. Hopefully you've heard us talk about really identifying unsustainable dislocations in the market, really focusing on identifying overreaction by the market, and then leaning in at that point. As Erik went just through some of the broad market numbers, with S&P, even with some of the rebound today, down about 8%, 13% peak to trough. These are clearly significant drawdowns, but given the event and given where asset valuations have come into it, it's not our view that this is a dislocation that's large enough to actually go risk on at this stage. Probably more importantly, just to link back to areas that we're really focused on, is really the sentiment signals and factors that are part of our framework. And while that is quite negative already, it's not in the panic range. Just to give an example, the volatility index, or the VIX index that we sometimes talk about, is one of those factors that are gauges that we look at. And it's running above longer term averages. And so long-term averages, it's in the teens. We're kind of in the 30s right now. It's well off what you would have seen like in March 2020 or other more larger dislocation events. So at this stage, we believe the best course of action is really to maintain current risk levels, be ready to trade, and really focus on managing towards what are the different paths that could come out of this, depending on how things play out. The other perspective that I wanted to share is just how we're mobilizing the team. Full stop. It's always better to over communicate during these events. And so we treated this as a high risk event from early last week, not because of the level of risk in our portfolio, but more because of the geopolitical instability that Erik had walked through and the risk that could add into the market. So in addition to our standard processes, we established a cross-functional crisis response team. We're meeting daily. We're looking at key risks, looking at market conditions, and just updates to ensure that we're executing on anything that we can actually act on on your behalf. We start out, just to give you a picture of those meetings, with trading and really thinking about our market access, what we can do in the market. That's been very fluid and changing throughout the last week and a half. Then we're shifting more to the macro discussion and the portfolio managers and talking about actual portfolio exposures. Right alongside us in this are our risk and compliance teams. The compliance team is helping us really understand the sanctions and making sure we're in full compliance. So those sanctions, they come out and as they shift, and then that's all kind of coded up. So we're very comfortable that the portfolios are positioned in a way that aligns with some of those sanctions are going to be critical, hopefully, to help manage through this situation. And the most important thing is we always end with the client. We talk about the communications that we're providing to you all. We want to make sure that we are giving you the right perspective on how important this is from your overall risk portfolio, but also just the talking points and information you need to understand what's going on more broadly. Being in this seat now for a year, and this is like the first kind of, I'd say, big event that I've worked on with the team, it really has shown me how just the benefit of Russell being this global investment platform with the technical expertise of the big firms, but being small enough to really get to all the experts to make quick decisions and judgments when we need to. And so feeling very good about how the team is operating. And with that, I just remind people that we're maintaining risk levels at the same levels we came in to the event with. We are actively looking at opportunities to make shifts in the portfolio, and we'll let you know if there's any material changes that we have to those views should that happen. And with that, I will hand it over to Rob.
Great, thanks, Kate, and thanks everybody for joining today. So as Kate and Erik walk through, I'm gonna go through three different things. The first is just the trading environment and what we're seeing out there, kind of in the weeds, the nuts and bolts of today of what we're able to do. The second is some perspective, kind of one level down from what Kate gave on the individual portfolios that we have, and where we're seeing the risks in the portfolio and the exposures that we have, and some of the market impacts. And then the third, we're very fortunate as a multi-manager platform where we have access to sub-advisors all around the globe and get their insights in real time. And we've been speaking with those money managers daily. And so I wanted to provide some of the feedback that we're getting from them to you all to give you a color of the broad spectrum that we're hearing from money managers. And there really isn't I would say, a consensus here. It's lots of different views that we're happy to share. So first, just starting off with the trading side of things, as Erik mentioned, it's been a fluid environment. Capital controls have been put in place, and there have been sanctions put in place as well. And so the first thing that I would say is we are fully complying with the wide range of sanctions, and we have a dedicated team that we've set up to ensure that we remain in compliance with those sanctions. And so that's the first thing, dedicated team there. I would say the second thing, I'm going to go through what's available in the marketplace. We're very fortunate in my seat as a PM. When we have a change in view, we have a wide toolkit in order to enact that change. Our trading team has global capabilities that are state of the art. And so what I'm going to talk about here is not limitations on our own trading, but limitations based on what's available in the marketplace, either from sanctions, closed markets, or liquidity. And so the last thing that I would say before getting into the details is our approach to trading specific to Russia has very much been one of what we should do rather than what we can do. And today, because we enter this environment with small exposures in an absolute sense, exposures that are not that materially different from the indexes in most portfolios, we think that it's best right now to quote one of my mentors, is thoughtfully do nothing. That there are depressed prices, so it's probably not the right time to distress sell, and it's probably too early where you can to buy things. And so thoughtfully maintaining those exposures is something that has been our general approach to trading overall. And so with that bit of background, just getting into what can be done. In the stock markets within Russia, first of all, they've been closed for the last 3 days. So this is the longest closure of Russian stock markets for an event since 1998. So it's been some time since something like this has occurred. That's meant that equity trading on local exchanges within Russia just isn't happening. If you own that stock, the trading is not occurring. Now, there are things called depository receipts, ADRs or GDRs. You may have heard these quoted as. These are basically wrappers around that foreign security traded on an exchange in London or in the US. And those depository receipts have traded in the last couple of days in a declining amount of volume. So on Friday, there were many money managers that were able to access, and once they started to sniff things, we're going forward, take some of that exposure down. In the last couple of days, we went from about 17 brokers trading those to 12 to 7, and today, those are really not trading at all anymore. And so stocks of Russian securities, broadly speaking, originally on the local market weren't trading at all, and now in the depository receipts are basically illiquid as well. And so from the stock market, there's not much that's being done. The second bucket, if we think about trading, is the currency exchange. Erik quoted before the ruble falling 30-35%, depending on the minute-to-minute pricing since this all began. Obviously, the currency is trading, but the liquidity in that currency, I like the quote that we got from one of the money managers. It's like putting a finger in the air right now to predict the ruble at the moment. The bid-ask spreads are very, very wide, and trying to get anything done in those is very, very hard. To give you a sense of that, we had a broker talk about trying to get $8 million of exposure traded, and it took them the entire day for $8 million. That would have taken seconds or less than a minute in prior market environments. So FX trading is happening, but very, very limited amounts. And then the third bucket, if I just go down to the bond side of things, the local currency bonds are very similar to the equity where the exchange is closed and there's no real trading going on. The hard currency bonds, which are US or European denominated emerging market debt, they are trading, but with lower and lower levels of liquidity. And our money managers that we talk to in that space say that where they're seeing trading, they're wondering how much volume actually is even getting done. And so The pricing that's being quoted is being done in very, very small size. To give you an extent of the changes in that market environment, spreads on Russian bonds went from 325 before this started to 1,600 basis points as of earlier today. Emerging market debt as a whole, just from the impact of Russia, went from around 325 to 425. So it's having an impact on that debt market, especially for obviously those bonds within Russia. And from a pricing perspective, that obviously has an impact on the bond price. And so bonds that were priced maybe at $100 a couple of weeks ago are now trading in the $25 to $30 range for what we're seeing quoted on Wednesday. So across the equity, FX, and bond market, there's very limited trading going on overall. Where it's happening very, very slowly and with wide bid-ask spreads. To give you a sense of the bid-ask spreads on the currency front, normally they trade very tight, call it 30 or 40 cents on the ruble. It's $2 to $3 per ruble on where it's trading right now in the bid-ask spread. So 4 or 5 times wider, up to 8 times wider on the bid-ask spreads than we would normally see. So that's kind of an in the weeds on the trading environment. Again, Russell is doing very limited amounts of trading in this area. There's small exposures in our portfolio, and that's where I'll transition next, the perspective on sizing of client exposures. Most of the clients that we work with come to us in the solution space for assets across equities, fixed income, real assets, private, public, and we put those together in a solution. And the way that we've been looking across various portfolios for clients, the exposure to Russia is quite modest, in most cases below 50 basis points in absolute sense, and right around the benchmark in a benchmark relative sense. So to give you an example, within the equity space, our emerging market fund is obviously the place where the exposure would be most natural for those investors that are invested in that emerging market exposure directly or via a multi-asset solution that allocates to emerging markets. The exposure there is even modest. You might think that it's a big economy with a big impact on energy overall, but the market cap is only around 3.5 percentage points going into this crisis of emerging markets. And of ACWI, the global equity market, including developed and emerging markets, it was less than 50 basis points. So overall, the benchmark exposure and our own exposure was quite small. Russia in general has been an area where we've done quite well through our money manager selection in the past few years. We've had overweights based on around a 75 to 80 basis point overweight 12 months ago. That's come down, and managers have taken profits after some strong outperformance in 2021, and we entered this about neutral to the benchmark. So within our emerging markets funds, around that 3.5% exposure. Today, after the falls, it's closer to around 1.6, 1.7, but again, right around the index. In the bond side of the portfolio, in the emerging market debt space, it's about Russia is about 6% of the hard currency debt index. Our clients get exposure to that through our active managers in that space, and I'd say there we've actually had more of a bias to a small underweight to Russian and Ukrainian debt. That's been one of the areas that one of our money managers effectively rotated, and I'll tell more about stories later, but effectively rotated to bring us a little bit underweight. But again, a small portion of your overall bond portfolio. In terms of the bond portfolio, again, less than around 30 basis points of absolute exposure in the bond space is what we're talking about. And so while there are experts that we have working in that space, overall exposure is small. And as Kate and Erik mentioned, the bigger impacts is what's happening to the broader equity, fixed income rates and credit markets. And so that's where we're concentrating on. What are the knock-on effects? We're not looking to go over or underweight Russia or lean into any individual securities there. And basically, because of the trading liquidity today, there's not much we can do anyway. And so where we've been looking is those other areas, looking for those unsustainable extremes, rebalancing, as Kate said. The couple areas that have been catching our eye more recently is in the high yield credit space, where we've been incrementally adding a little bit. These are areas where we've had underweights to high yield credit for the total solutions of clients over the last 12 months because we've thought that spreads were too tight. Now they're starting to move back. And so we're incrementally, that's the one thing in the last month or so that we've been incrementally adding a little bit to be a little bit nimble as spreads have moved out on high yield CDX from under 300 basis points to almost 400 basis points in the last month or two. Maybe pivoting now to the multi-manager approach that we have. And I think this is an important element that Russell differentiates itself. We've seen in the past couple of days a number of funds, either in the emerging market debt or equity space, close and gate their funds because of the Russian exposure that they've had. Obviously, being a multi-manager, our exposure is more limited. We're less concentrated in one market or another, and we get more diversity across many different countries, many different markets, and don't have those issues. And we also get a lot of varied perspectives. So on those varied perspectives, I think it's important what we've been doing in these last couple of days. We've been talking from the emerging market and the global equity side that have exposure to Russian and the exposure and the emerging market debt strategies on a daily basis. We're having dialogues with them, getting their insights about where they're finding opportunity, what they can take advantage of, where they think they need to exit but can or can't, how they're pricing those individual securities. And I would say the first thing is that there's no real consensus around where things go from here. Obviously, we're dealing with geopolitical crises where managers have some perspective based on past experiences, but we're all navigating new territory with this invasion. And so we're getting a wide-ranging area of perspectives. What I would say in one camp is on the equity side, we've had a few different money managers that have said, going into this, we liked the growth rates that we were seeing in Russia, the valuations. In many cases, they were able to buy high-quality businesses that were trading at 4 times long-term earnings. And so companies that they thought were quality and now are some of the cheapest in the world, obviously. Obviously, that can go very bad if we continue to escalate on the war, and as Erik talked about. But if we do see similar experiences we've seen of the last crises, those can maybe offer significant amount of value. And so the money managers, some are following that value discipline, pricing things with big risk premiums because of the issues going on, but are maintaining those exposures and trying to slice through where are the opportunities and where are the risks. I would quote one money manager that we talked about today that said, we're at a market of stocks, not a stock market within Russia, and there are winners and losers from this. And there are many companies there that have revenues that are based in dollars because they are energy producers. And if you think about a company that is producing energy and energy prices are going up, if things do quell and we do get calm, that obviously is a positive revenue source and something that should be a winner over the intermediate term. By contrast, some of the banks that are having issues that are being removed from SWIFT could have significant issues. And so even today, where there's not something that the money managers can trade, figure out where are the things that are the opportunities, where are the risks, what do they want to avoid for when those markets do open back up. On the fixed income side, I'd say our money managers have been positive in terms of rotating out. We had one strategy that was concerned about geopolitical risk in the fourth quarter of last year with Russia and Ukraine, removed all of their Russian exposure. They were at around 6 percentage points, went down to around 0 percentage points, and our portfolios have benefited. We don't have any money managers that we've talked to that are beginning to think about legging back into that hard currency emerging market debt, the area that actually does trade right now. And so broadly speaking, I would say the money manager community is split. We have some that are trying to stay clear, that are thinking that these are uninvestable, others that are thinking through who are going to be the winners and losers if we do return to normalcy and trying to risk manage if we don't. And then I think one other unique aspect is what are the knock-on effects for other areas? We've had one money manager talk about Taiwan and Chinese exposure, and should we be thinking about the risks to Taiwan and Taiwanese securities that have done quite well over the past few years and maybe taking some of the exposure down there. We've seen some of that from other strategies. And so broadly speaking, trying to harness those manager insights, bring them to bear to our clients, to our portfolios, and make sure that we're thoughtful about where the opportunities and risks go forward.
Look, we have a few questions we'll get to in short order, but I just kind of put a wrapper on all of this. Look, this is a tragic, complicated human, tragedy that we're seeing unfold in front of our eyes. And we can't underestimate the impact of that. But as it relates to financial markets, for most of our clients, their specific exposure to Russia and the Ukraine and Belarus is de minimis. It is effectively a rounding error. I mean, that doesn't mean it's not important. It just means you got to put it into perspective. The concern is that this escalates from a kind of geopolitical question around national defense issues around Russia and their territory, and that to a macroeconomic event. We've talked about those escalation paths that we think can, have to be monitored and could really have an impact. The reality is our view today is as much as it was. I talked about our view on Fed policy. I talked about our view on inflation, subsequent to what we've seen. But our overall view of kind of cycle valuation and sentiment remains where it was before this started, which is we are constructive on equities. We think the cycle is continuing to be supportive of equities. We're watching that very closely, particularly around the price of energy and its potential macroeconomic impact. We think valuations clearly, as Kate mentioned, we're off. We're 8 to 12% off of the highs that we saw recently. So we have seen a drop, but all that drop basically occurred before the war. And we still think we're kind of where we were, when we were assessing it then. And we thought valuations, although not cheap, were certainly more attractive than they were. And sentiment, frankly, there's enough fear in the marketplace that you begin to actually look at sentiment and say, well, maybe, when that fear really gets bad, that's the time to go in. That's a powerful predictive tool for when to get back in and risk up. So we're in. We're maintaining our risk levels. We're neutral relative to our policy portfolios broadly, and we're monitoring it closely. We have had a couple of questions. One question was, I just recap it. There's a question about kind of what price of oil do you become concerned? I kind of mentioned that, but I did it quickly because I talk fast. 130, 150, that's probably when you're in the danger zone. But we are a much less energy dependent economy in the U.S. and kind of globally on fossil fuels than we were in the 70s, where price shocks were enough to drive us into kind of recession no matter what. That's not the case. But there is a lot of questions around, there are index providers that are talking about getting Russia out of the index. In fact, JP Morgan on their ESG bond indexes have already done that. But MSCI is looking at the issue actively, and it's an issue we're looking at very, very seriously. And let's move aside the ESG issues. Right now, Russia's not a functioning capital market, right? And that actually was the goal of the sanctions. Like the sanctions and goal was to create havoc in the financial and capital markets of the Russian economy. They've been very effective so far, and we would expect they would continue to be effective. So I guess the question long term is Russia an investable market? That's, I think, the question that the index providers will look at. That's a question we're seriously looking at. And Kate and I have talked about it several times today, in fact. And we expect that'll be kind of top of mind, top of the boil in terms of what we're looking at. The ESG related issues are obviously something that we need to consider as well, and we are. But the first principles is this may not be a market you can actually invest in long term, but we'll kind of let you know as we get closer to a conclusion on that. Kate, you mentioned experts in your comment. We got a question on kind of what experts have we talked to. You probably can't be specific with names, but you can kind of give us a sense of who we're talking to.
Yeah, definitely. So when we think about some of our research partners that we've been leaning into are more of their geopolitical teams, just to get some different perspectives, both on Russia and Ukraine, but also potential knock-on effects. People have extended this and linked it to, is this a blueprint, if you will, for China and Taiwan, et cetera. And so that geopolitical research angle is one of the key ones. Certainly on the trading and custody side as well. A lot of this is just in terms of like, what can you actually settle, what can convert? And so we're making sure that our understanding is in line with what other people are seeing in the markets. So some of the trading custody experts that we engage with, and of course the sub-advisors. You get such great intel in terms of opportunities and risk there. And so I'd say probably in that order in terms of risk is where we've been going. Yeah.
Well, thank you. And we got a question, and this is somebody who's actually really, really familiar with the dynamics of what's going on, particularly in the Ukraine. Ukraine is responsible for the vast majority of neon gas, which is a critical element for semiconductor manufacturing. I didn't know that a week ago. I only found that out this week. Yeah, they ask, is that a point of watch? Yes, that's a point of concern. Obviously one of the things that have created the inflationary pressure that we've seen so far in the last 12 months has been supply chain disruption, and very specifically in the semiconductor industry. So yes, we're seeing how that all plays out. it's in Russia's best interest to make sure as much global economic activity that can flow out of their territory continues to flow. So, we've got to kind of work with the experts in that space, both geopolitically as well as in terms of the investment managers that have expertise in semiconductors. But yeah, it's definitely a watch point for us because it may lengthen the amount of supply chain disruption, and that may have a knock-on effect to inflation as well. Yep, very good question though. I'm going to quickly scan the list. Kate and Rob, you can probably look into the list of questions. Any ones that I've missed? We did get some specific questions on Lukoil and Sberbank of Russia. I think that kind of falls into that broader category of looking at Russia as a whole. It's important to understand that the banks affiliated with the energy sector of Russia have been excluded from this, as I mentioned, because Europe has a huge dependency on Russia for energy. But that's something that is a constant watch point.
Yeah, and that's like one of the interesting points when you think about Russia investment, both in terms of capital market functioning, but also on principle. That like at what stage, if a Lukoil or some of these companies are not state owned and are a functioning company, at what stage on the other side is it investable? Is it possible? And so, yeah, I think it will be, and this is where the benefit of active management will come in, is like that company by company decision on what does their future actually look like, and what could be a very changing, political or geopolitical landscape for Russia and how they're interacting with the world. So Lukoil and Sberbank are actually two good examples of ones that you could have very different outcomes, even if the concept of the corporation makes sense. How they can operate could be very different on the other side. Yeah.
So again, I think we've gone through most of the questions, and it's always good to give people back time in their day. Any questions we didn't address, let us know. We'll get to them. We want to make sure that we keep you informed as the events unfold, and hopefully this conversation today helped understand at least our perspective and some of the details as we view them in terms of the crisis and kind of the ongoing potential effects. But please do maintain contact with your client representatives and let us know if there's anything we can do in extension. And I'll leave the last closing comment to you, Kate.
Well, thanks everybody for taking the time and joining us today. We want to be in front of you and making sure you're getting great content from us. But it's in a tough situation that even if it's far away from us in the U.S. and North America, a lot of people have connection points on the continent in Europe, and so we just want to be focused on your portfolios, but very cognizant of the broader impact that it's having. But thank you for joining.